Happy morning, people. So let's continue our revision discussion. Now, next we are revising Accounting Standard 25 that talks about Interim Financial Reporting, or IFR we can call it. First of all, AS 25, not mandatory, totally optional. Which company have to prepare IFR? How often should they prepare IFR? Whether 3 months once, 6 months once, 2 months once, period not defined. Totally whose choice? Company's choice. If at all IFR as an interim financial reporting is being prepared, how to prepare it? AS 25 gives the guidance. Okay. And AS 25 and Ind AS 34 same. This topic ditto, almost same and final, no change. Okay. All right. Sir, what is this interim period? What is this interim financial reporting? But first, to know what is interim financial reporting, you need to know what is interim period. Interim period means any period less than 12 months. Any period less than 12 months. So that could be 2 months, that could be 3 months, that could be 6 months, 7 months, whatever. Any period lesser than 12 months gets called as what? Interim period. And for that interim period, if you are preparing any financial statements, for that interim period, if you are preparing any financial statements, we call it as interim financial reporting or interim financial statements. Usually listed companies have to give the data to SEBI. How many months wise? Quarterly, right? So usually companies prepare interim financial statements on a quarterly basis. But that recommendation is what? That is mandatory as per accounting standard or SEBI guidelines. SEBI guidelines says you have to give quarterly information, hence they do it. Does it mean interim financial statements always have to be prepared quarterly or company choice? As per AS 25, you can prepare whatever months you want. You can prepare monthly also. You can prepare 6 months once or quarterly once, half yearly once, whatever. Fine. And is it mandatory or company choice again? To prepare or not to prepare also is totally the choice of the company. If at all you are preparing, you will apply which standard ka guidance? AS 25 ka guidance. So you got to know what is IFR now, what is interim period now. Okay, moving forward. Sir, how should this interim financial statements be prepared, sir? Simple, sir. AS 25 gives a choice. What choice? Either you can prepare interim financial statements just like the way you prepare annual financial statements. The way, the mannerisms, the presentation, the disclosure that you give in annual financial statements, same thing can be applied for interim financial statements also. That is one way. That we call it as complete set of financial statements. What do we call it as? Complete set of financial statements. Or company can also prepare something called condensed set of financial statement. So company has what choice? Either they can prepare complete set of financial statements or condensed set of financial statements. Condensing means showing full or shortcut. Shortcut. What shortcut? Sir, if you go for condensed financial statements, what AS 25 says is the heading and subheading. The heading and subheading of IFR should match with annual financial statements. The heading and subheading, can you change or it should not be changed? It should not change. Like what is the heading in main balance sheet? Below particulars, you will write equity and liabilities. Under equity and liability, shareholders funds, right? So those headings and all you cannot change. It has to match with what? IFR ka heading and subheading should match with annual financial statements. But the additional line item is company choice. Like under current assets, you show debtors, inventory and all. No, that is company option. You can just say current asset is 1 crore. You don't need to give the breakup. So the additional line item is basically company ka choice. But heading and subheading has to be compulsorily matching. IFR ka should match with annual financial statements. Again, not that important. Just one marker ka MCQ. They may here and there target. Okay. Even in IFR, you should report BEPS and DEPS. Basic EPS and diluted EPS. Disclosure not important. This, yeah. Usually 3 types of questions, if at all ICAI wants to ask, they will ask. At inter level also, final level also. This is one. What is that? Okay, let's just understand that with the help of a small example. This concept we call it as period of IFR. Now let's assume company is preparing IFR on a quarterly basis. They are preparing on what basis? Quarterly basis. Mandatory or company choice? Company has opted for what choice? preparing IFR on a quarterly basis. Let us say we are in second quarter. We are in which quarter? Second quarter. First quarter is what period? April, May, June is first quarter. What is second quarter ka period? July, August, September. So for July to September, company is preparing IFR. Yes. Sir, financial statement means what and all is a financial statements? Can you tell me? What and all put together will become financial statements? Balance sheet, P&L, cash flow statement, notes to accounts. Correct. Now, there's one more called SOCI that you learn in your CFI. It's not there in the accounting standard requirement. Okay, Ji? Okay. Now, this particular concept is saying for what and all period will you prepare balance sheet or P&L or cash flow? Because if you remember, do we give only, when you prepare annual financial statements, do we give only current year data or also previous year? For comparison purpose, we also give previous year. So for IFR, what period data you need to give is the question. Okay. Let's assume that IFR is prepared for which quarter? Quarter number 2. It can be for anything, but for simplicity purpose, I have assumed it to be quarter 2. Now, first, when you are preparing balance sheet and IFR, when you are preparing balance sheet of IFR, balance sheet you will prepare as on what day? Starting date or ending date? Here the period is ending on what day? 30th September. So let's assume it is 2025. So one balance sheet you need to prepare as on 30th September 2025. Okay, Ji? And you have to give previous year ka annual financial statement for comparison purpose. Current year has ended or we are in second quarter? Second quarter. That means previous year ending date is what? 31st March 2025. So that balance sheet also you need to give for comparison purpose. One balance sheet for the period ended, another balance sheet for what? Previous year ka annual balance sheet that you need to give for comparison purpose is what they have recommended. Though they are not totally comparable, but anyway, I don't know what the thought process behind standard setters by giving annual. I feel better would have been 30th September 2024 ka balance sheet. That would have been more comparable, but anyway, I'll not go into the cross question mode over here. But did we understand this? For these two period, you need to prepare balance sheet. Next comes what? P&L. P&L you prepare as on a particular date or for a particular period. P&L is always prepared for a particular period. This particular quarter period is what? 1st July 2025 to 30th September. So one P&L you will prepare from July to September. How many months? 3 months. Same 3 months ka last year data you need to give. Same 3 months ka last year data you need to give. Okay, Ji? This is one. Current quarter ka P&L as well as last same quarter ka P&L you need to give for comparison purpose. This is one. Another one, you also need to give YTD data. YTD means year to date or year till date. Now here, second quarter is beginning on 1st July and ending on what day? 30th September. But the current year is beginning on what day? 1st April 2025. So you have to also give year till date ka information. Year to date ka information. When has the year started? April. Currently you are on which date? 30th September. So that means you have to prepare one more P&L from 1st April to what day? 30th September. From 1st April to 30th September. How many months is that? April, May, June, July, August, September. How many months? So YTD information of the current year you need to give. Similarly, same YTD information of the last year. So tell me what is the period? 1st April 2024 to 30th September 2024. So these are the 4 information or for the period for which you need to prepare P&L and present. So much, sir. Practically nobody will apply this. Sir, if it's a choice, anybody will like to do extra work. No, right? So practically no company will do it. But if at all anyone wants to do it, they have to comply with all of this like that. So balance sheet over, P&L over. Next is what? Cash flow statement. For cash flow statement, you only give YTD information. You give only YTD. That means tell me what is the period? YTD means what? From the year beginning till the current date. Current date is ending on what day? 30th September. Year begins on what day? 1st April. So cash flow statement you will prepare from 1st April 2025 to 30th September 2025. Same YTD information you have to give it for the last year also. YTD of current year plus YTD of previous year. So these are all period for which you need to prepare IFR. This is one type of question that can be asked. Give us they will give you, usually they will give you quarter 2 only. Usually, they may also give quarter 3 also as a question, but usually we say quarter company is in the quarter 2 and what and all period we need to prepare. So this and all you need to list out. That's all. Can I move forward to the next one? Yes, sir. Okay. Next is something called people. I'll tell you one sentence. If at all, okay, ma. I'll go. You want me to go slower? No. Want me to go faster? No. So next concept is on the deferment concept. Next one is on the deferment. If possible, try to remember the exact these words, because if at all they give you some 3-4 marks ka question with one line item, you may have to call out this provision. The exact words of provision, if you use, higher marks you will get. First I will tell you the exact words, then I'll tell you what does it mean in the simple terms. What AS 25 says is, revenue earned seasonally or occasionally should not be anticipated or deferred in interim financial statements, provided its anticipation or deferment is not appropriate in annual financial statement. Exact words. Second one, cost incurred unevenly can be anticipated or deferred in interim financial statements, provided it is appropriate to anticipate them or defer them in annual financial statement. Exact words, if you can remember. In simple terms, how you recognize a revenue in annual financial statements, in the same manner you have to recognize revenue in IFR also. The way you recognize revenue and cost, where in annual financial statements, same way you have to recognize revenue in IFR also. Like just an example. Sir, if performance, let's take the example of sale of goods. What does AS9 say? We have done AS9, no? Goods ka revenue should be recognized when performance obligation is satisfied. There are some indicators, condition which proves when performance obligation is satisfied, correct? Huh? If performance obligation is satisfied today, when will you recognize the revenue? Today only. In annual financial statements, when you are preparing, if performance obligation is satisfied today, you will recognize revenue today only. In annual financial statement, if you are recognizing revenue today, in IFR also you should recognize today. Same way. You can't change the basis. In annual I will recognize based on performance obligation. In IFR I will defer. Acceptable or not acceptable? The day performance obligation is satisfied, in annual financial statement and in IFR you should recognize revenue. Pushing is not allowed. Okay. But certain income gets pushed. You remember AS 12? What is accounting standard 12? Government grants. If there are conditions attached, let's say government gave you a grant of 10 lakh and told you have to train your employees for 4 years. You have to give training to your employees for how many years? 4 years. This is capital grant or income grant? Income grant. So where it will go? To P&L. It will go to P&L immediately or over 4 years. So when you prepare annual financial statement, this government grant, you are transferring it to P&L immediately or deferring? In my example, how many years? 4 years. In annual you are deferring means in IFR also you will defer. That's all it means. The way you are recognizing the revenue and cost in annual financial statement, in the same mannerism you have to recognize revenue and cost in IFR also. Did we understand? That's all these two fancy sentences trying to say. The policies, the accounting should not be changed. Basically, the policies of IFR and annual financial statement should be same. That's all. Okay. Doubt or carry on? Okay. All right. Next one. This is another one. We'll take a one question. Using this, there's one question which they ask. We'll take a one sample question also. One more last concept is there which may get tested. That is called tax expense. In P&L, you book tax expense. Do you remember? All right. Now people, in IFR, you book tax expense on something called, tax you pay to the government based on estimate. Yes or no? You have studied tax and all, right? We pay advance tax. How do you calculate advance tax? Income Tax Act says you need to estimate how much is going to be your whole year ka income. Based on that, you calculate tax, and a portion of that you pay to the government. Yes, no, some portion is there. Whatever. That is different for individuals and different for companies. Agree now? Yes. So that means tax is an estimated thing. Advance tax that you pay on a quarterly basis and all is a estimated thing. Yes or no? What AS 25 says is we have to find something called what hour. What we have to find? What hour? Weighted average annual tax rate. What hour? Weighted average annual tax rate. Based on that tax rate, you will book something called tax expense in your period. So how do you get this weighted average annual tax rate, or what hour, sir? Expected tax expense in the current year divided by expected accounting income of the current year into 100. Expected tax expense in the current year divided by expected accounting income of the current year into 100. I told you the logic of all this formula. Now I'll not go too much into all that stuff. Okay, this is basically your average rate. This is basically your average rate. Find one average rate. Based on this average rate, every interim period ka tax expense you book. Usually data will be given quarter wise. So every quarter you have to book tax expense using what? Water. So yes, this is another kind of problem. This is another kind of problem which can come in the examination. So there are broadly three bases or three types of question that gets tested. Now can we take up one question on water first, just to have a little better idea? First of all, what does what hour mean? Full form is weighted average annual tax rate, or simply average tax rate. Now how to get that? Let's learn it through this question. It's a study mat question and our class notes question as well. An enterprise reports quarterly. So IFR is done on what basis? Quarterly. Annual income is how much? Annual, not quarterly income. Annual income estimated is how much? 10 lakh. Okay. Assume tax rates on first rupees 5 lakh at 30% and the balance at 40%. So we have to pay tax to the government on a slab basis. You know, for individuals, we have slab basis. Okay. Now, this particular enterprise also is getting taxed on what basis? Slab basis. No, sir, company gets taxed at flat rate. Don't question the question. If question says slab, you will have to follow slab. As simple as that. Okay, now let's not go into that cross questioning mode. So how it is getting taxed? Tell me. On the first 5 lakh, how much tax you need to pay? 30%. On the balance income, you have to pay 40%. So first calculate the tax expense for me. How much is the income expected? 10 lakh. Okay. So out of this 10 lakh, on first 5 lakh, how much tax you will pay? 30%. So 5 lakh into 30% will be 1 lakh, 50,000. Agreed? Balance income. Out of 10 lakh, 5 lakh is getting taxed at 30%, means balance income is how much? Balance is other 5 lakh. The other 5 lakh will get taxed at what rate? 40%. So calculate 5 lakh ka 40%. Means how much is the tax expected to be paid in the current year? 3,50,000. Got it? Because water ka formula, tell me once again. Expected tax expense for the current year, which is in this case how much? 3.5 lakh divided by expected accounting income for the current year. Tax expense for the current year expected is how much? 3,50,000 divided by expected accounting income is how much? 10 lakh. Sir, this is taxable profit, na sir? Sir, if they have not given any information, here we assume accounting profit, taxable profit are same. Accounting profit, taxable profit are same. How much is the accounting income then? 10 lakh. Tax expense expected is 3.5 lakh. Accounting income expected for the whole year is 10 lakh. Into 100, you will get the percentage. How much is that? 35%. That means we will book tax expense in the current year using what rate? 35%. In where? In annual or in IFR? In IFR, using 35%, you will book the tax expense. Now, tax expense is based on profit. They would have given quarterly profit. Check. The estimated quarterly income is first quarter how much? 75 lakh. So what is tax expense? First quarter, if you are expecting to earn 75,000, what is the tax rate? Tax rate or water? Water. What is water? 35%. So calculate 75,000 ka 35% how much? 26,250. What is that 26,250? Tax expense for first quarter. Similarly, what is second quarter ka income expected? 2,50,000. Take 2,50,000 and multiply water 35%. We'll get 87,500. Third quarter ka income and fourth quarter ka income is 375 and 3 lakh. Take this and multiply water ka rate. You will get tax expense for the respective quarter. This is how you will book. Okay, Naji. This is another kind of question that can come. Are we good with this? Okay. One last kind of question is there. Can we take that up? You remember that revenue and cost wala adjustment? In simple one-liner, what is it? The way you recognize revenue and cost in annual financial statement, same thing has to be done in IFR also. So that concept ma one question, again study math question. Antar Bharati Limited reported PBT of 4 lakh for which quarter? Third quarter. In these sort of questions, how it will be given is they will give you PBT. Then they will give you certain adjustments of what they have done. What they would have done, no, there will be some errors. We need to rectify that and find out what? The correct profit or adjusted profit. That's all we have to do. Okay, take your calculator. How much is the profit they have given? 4 lakh. All we have to do is here plus minus. That's all. Okay. Now, first adjustment, let's check. On inquiry, you observe the following. So, first, dividend income is how much? 4 lakh. It is received during the quarter. The quarter means this quarter. Current year, current quarter, may you have received dividend income how much? 4 lakh. Stop. Sir, if you have received dividend in this quarter, what do you have to do? Account it in the next quarter or this quarter only? Think about it. When you're preparing annual financial statements, if you receive the dividend for current year, will you book next year or current year only? Current year only. That means in annual, are you deferring or accounting immediately? That means in IFR also it should be accounted immediately. How much is the dividend for this quarter? 4 lakh. How much income should be booked? 4 lakh. What did the accountant do? They recognized only to the extent of 1. They only booked how much? 1. Balance 3 they want to defer. Acceptable, not acceptable. In annual can you push? No. That means in IFR can you push or not acceptable? Not acceptable. So how much income is not recognized? Out of 4 they booked only 1. How much is not recognized? 3. What do you have to do? Now you have to recognize when you book an income, P&L will be same or it will increase. So what we have to do? For this, you have to add 3 lakh. So in your calculator, 4 lakh plus 3 lakh. Like that, we'll have to go on adjusting. Got the base? Okay, next one. 80% of sales promotion expense. How much is the total sales promotion expense? 15 lakh. Of that, 80%. 15 ka 80% is 12 lakhs. Now. Yes. What have they done? Check. Incurred in which quarter? Third quarter. 1 second, hang on. So sales promotion expense means some selling expense. Visualize. Sir, when will you recognize selling expense in annual financial statement? When it is accrued, when it is incurred, will you defer it or book it immediately? Book it immediately. I mean, this expense, can it be deferred? No. It should not be deferred, but it should be recognized when it has accrued, right? Now check. 80% of the sales promotion expense of 15 lakh, which incurred when? Third quarter, but it has been deferred. To what quarter? Fourth quarter. One expense they have deferred. Acceptable, not acceptable? Not acceptable. How much they have deferred? Full law, 80%. So calculate. 15 lakh ka 80% is how much? 12 lakh. Deferred means they have accounted or not accounted in the current quarter. They have not accounted an expense. How much amount? 12 lakh. Acceptable, not acceptable? So what we have to do? Recognize that expense. When you book an expense, P&L will be same or it will reduce. How much you will reduce? 12 lakh. So due to this adjustment, you have to do minus 12 lakh. Okay, Ji? Fine now. Okay, next one. In the third quarter, company changed the depreciation method. Can you change the depre method? Yeah, depreciation is based on pattern of economic benefits. If pattern of economic benefits changes, depre method also can be changed. Yes. Okay. In the third quarter, depre method has been changed from WDV to SLM, which resulted in extra depre of how much? 12. The entire amount has been debited in third quarter only. Okay. Sir, this is a change in accounting. This is a change in accounting estimate. Correct. This is a change in accounting estimate. Whenever accounting estimate changes, what does the standard say? Retrospectively or prospectively? Whichever day you change the estimate, that day you give the effect. Correct. That day you account it. So push it or account it immediately. Account it immediately. What have we done? We have accounted it immediately. Anything wrong we have done or correct treatment? Correct treatment. That means should we have to do anything for this or no treatment? Everything should have been accounted in the current quarter and they accounted in current quarter only. So the treatment given is absolutely correct. So nothing to be added, nothing to be subtracted. Can I move forward to the next? All right. 2 lakh extraordinary gain. Extraordinary gain. Received when? Third quarter. Stop. Sir, if you receive some extraordinary income when you're preparing annual financial statements, will you defer it or book it in current year only? Book it in current year only. So in annual financial statement, are you deferring or booking it immediately? Immediately. So in IFR, will you defer or book it immediately? Book it immediately. How much is this gain? 2 lakh. When have you received this? Third quarter. We are in which quarter now? Third quarter only. What did the company do? They allocated to third and fourth quarter. They are not booking entire amount immediately. They are deferring over third and fourth. That means this 2 lakh, how much have they booked in third quarter? 1 lakh, because they are deferring over third and fourth. Out of 2 lakh, 1 lakh they recognized in current quarter. Other 1 lakh they are saying they will book it in next quarter. Acceptable? Not acceptable. Not acceptable. How much income is not recognized? 1 lakh. Out of 2, they only recognized 1, means the other 1 lakh is not recognized. So what we have to do? Book it. Due to the income, what impact on profit? So add 1 lakh because of this adjustment. Next. Okay. The cumulative loss resulting from the change in method of inventory valuation. So if you change from FIFO to weighted average or weighted average to FIFO, is it an accounting estimate change or accounting policy change? It's an accounting policy change. Policy change should be applied retrospectively. Yes. Okay. Now you change the method of inventory valuation and this resulted in gain or loss? Loss. How much loss? 3 lakh. Okay. But out of this loss, only 1 lakh relates to previous quarter. So previous quarter, it's a retrospective adjustment. Yes, no? Previous quarter ka loss, can you recognize this quarter or previous quarter only? Previous quarter only. So this 1 lakh, out of this 3 lakh, 1 lakh is not loss for the current quarter. It is a loss for the previous quarter. So what we have to do? But this loss is already accounted in current quarter. One loss, extra loss has been booked in the current quarter. When you book a loss, what will happen to P&L balance? Reduce. So what we have to do? Add back. Add back how much? 1 lakh. So add 1 lakh. Last one. Sir, we sold an investment in first quarter. When you sell an investment, you will make some gain or you will make some loss. Here, what did we make? Gain of 20 lakh. Stop. Sir, when you sell an investment, when you get a gain, when will you book that gain in the annual financial statement? Next year or current year? Current year. So in annual, are you deferring or booking it immediately? Immediately. So that means in IFR, can you defer or immediately? Immediately. When was this gain relating to current quarter or first quarter? This gain is relating to first quarter. So you should book when? First quarter only. What did they do? The company apportioned this equally to all the 4 quarters. They are saying we will book this gain in all the 4 quarters. That means in this quarter, how much gain have you booked? In a year, how many quarters are there? 4 quarters. So 20 lakh they are allocating among the 4 quarters. So how much did you book in this particular quarter? 5 lakh. Acceptable, not acceptable? Not acceptable. Why? Is this 5 lakh current quarter or current period ka gain or first quarter? But when have you accounted? In this quarter. One gain you are booked in this quarter. Due to this gain, P&L balance will be same or increase. What we have to do? Reduce how much? 5. So minus 5 lakh. Once you do all this stuff, you will get a revised profit called, here it is, a revised loss of 8 lakhs. Okay, Naji? That's all it is. Done. With this standard is completed. Thank you.